Welcome to the wrap up for another insane week out there in the markets. This has been fun to watch. I am glad I am a systematic trader where when it comes to trading, all I'm doing is waiting for my alerts to come in from the Discord bot and placing the trades if I end up liking the setups. Just a lesson or a tip for when volatility is high like this, just stick and move, right? Trade a little bit less size. Try to just churn out a couple bucks here or there. Understand that the good times will be back. They're just not really here right now when it comes to just buying and following a wicked trend on a crazy mover that's going to go up day after day, week after week. It's just not what we're seeing. And we will see that again eventually, right? At some point that will return. But right now we're chopping and it's absolutely fine. This is just part of what markets do. I gave a whole kind of speech earlier on the channel about how year 3 of a bull market's usually choppy. That's exactly what we're getting. So, as always, what we're going to do is we're going to dive in. I've got some sectors that I want to highlight for you guys of things that to pay attention to for next week. I'm going to give you one idea that happened this week on the alerts with StatsEdge Pro, and then I wait for the market to close, and then I run all of the data, millions of trades and simulations go through 30 years of back tests across 4 different strategies. Those get sent to StatsEdge Pro subscribers, so we know exactly what we're going to trade next week. If it hits our certain prices, where the out is, where the stop loss is, all of that is completely and utterly handled. So makes it a lot easier to watch the markets when we have all of that kind of planned out, especially when things are so wild and crazy. So if you're interested in that, if you want to get serious and have some statistics behind your trading and have trading plans built behind everything that you do, come on over to statsedgetrading.com, give it a try. The people that are there really like it, and for all of you who are members, I appreciate you guys very much. The growth has been phenomenal, especially considering how hard this market has been. So let's pop into. Always got to start with Bitcoin. So I'm going to just title this one like support holds for now, because if we're going to go through a whole bunch of charts pretty quickly, it's not going to be a super long episode because the theme is the same, that we got buying into the end of the week where we needed to get buying in order to have the support hold. Now, next week, this could break and just roll over, or it could just be a continuation of this trend. So Bitcoin, right? This was the candle that happened, I believe, on Sunday night when they talked about a Bitcoin reserve. I don't even know what that is, but massive pop, sold back down, and you can see just kind of chopping in the range. But we're slightly above this box that I drew, and basically just looking at the low of this wick, which is about 89,000. So anywhere between 89 to 91,000. That's why you'll always see me draw support and resistance with these shaded areas as opposed to just looking at a specific point, because I've been taught to draw my support and resistance with a crayon and not a pencil because they're zones. So that 89 to 91,000, so I'm just going to call it 90K, that's really important. We're a little bit under that right now, but a big bottoming tail today. Uh, if we end up breaking down and this ends up turning into a bear flag, then of course we're watching the lows. And the lows were 77,000. That was kind of a flush low. There's a lot of liquidations that happened there, a lot of stop outs. And if you look at a lot of these other, let's do Solana, well, a lot of them look the same. So if you zoom out on Solana, massive area of support holding for now. Ethereum, massive level of support holding for now. Uh, Another one, Doge, was interesting. Doge, right? Prior resistance right here, acting as support and holding for now. So a lot of this stuff is holding. Now, one area of support that didn't hold was the Dixie, the dollar index. So I was talking about this for a long time, that we broke out and then we were testing this level. And if that held and pushed higher, generally speaking, that's going to be bearish for stocks. Although some of these correlations that have existed for the last couple of years are just breaking entirely. We're seeing dollar down the same time we were seeing stocks down. So we need to keep that in mind, but we are back into the range of the dollar. Now remember, we got a lot of our gains when the dollar was going sideways. When the dollar broke out, that's where the market got a little bit scary. So now that we're back in this range, if we can consolidate in here, that's good for the dollar. I'm not a macroeconomist, but if you think about it, if you're running a major corporation and you're buying and selling from all different parts of the world, if the dollar is going crazy, it gets really hard to estimate, okay, I'm going to make this much, I'm going to make this much, this how much this widget's going to cost, and here's the margin that goes into this. If the dollar is steady against the other currencies, becomes budgeting and everything becomes a lot easier, and it kind of alleviates that foreign currency risk. So we're back into this range, but some consolidation would definitely be something that we would want to see there just to get that overall strength. So we look at the SPY, talk about support holding for now, right? We look at, let's remove that. That was a line from something else. But if we take a look at this low. So this low right here was the prior low from tariffs or something. I forgot what happened in January. But the reason I'm anchoring to that low is because we had that gap down and rip. That's where, so buyers aggressively came in that level when the market was gapping down. Now we are back to that level, and you can see what choppy action. Again, very, very hard to trade. I'd imagine day trading for some little bit I do, it's definitely been hard, where you have a push down and then a pop back up and then a push down and then a pop back up and then a push down and pop back up. So this area, there is some amount of emotion behind. So why these areas work like this, where there'll be a bit of a bleed through and then a push back up, in my estimation, is what happens is, from, when I worked in hedge funds for 10 years, you're not buying just at a point. You're not saying I want to buy a stock at 10 bucks and you're buying the stock at 10 bucks. You're saying I want to buy it at 10 bucks, so you create a entry algorithm that anytime it's under $10, it randomly spits out orders under that $10 area, because that's what you want to do. You want to get filled, and you want it to be random, and you want it to be sparse instead of one big order, so that you're not tracked by day traders. They don't say, oh, there's a big guy here at $10 buying, I'm going to buy it 10.01, flip it out at 10.05, and do that over and over again. I used to do that when I used to trade prop before things got this sophisticated. So the fact that you have this undercut of this support and then a pop back through later in the day, that kind of just tells me that there's institutions, there's funds that on these dips, when we get to certain levels, they're turning on these buy algorithms and they're just pushing the price back up over and over again. Now, for how long and for what reason, we have no idea. Is it short covering? Is it someone who's short up here and then they're just covering down here? Maybe. So he's just going to cover a little bit of shares and then move on with his day. Is it someone buying here to take a big position? We don't know that either. But we know that now this range, this 575 to 565, which is pretty wide range, that is our new kind of support zone that we need to keep an eye on. If we get back and we close back, so again, it's still 45 minutes left in the day, so this thing could end up down here. But if we close down in these lows, then we have done a weekly close under this major level that has been so important for the overall market, right? This level right here, you can kind of extend this back like this, right? So this is kind of we are in a range zone. If we are outside of that, then we are outside of a range. Now, wouldn't surprise me to see maybe an up week next week, and then if it's going to continue, roll over the week after that. That wouldn't surprise me at all, or it wouldn't surprise me if we're just chopping in this range. Now, for the guys out there who like the broadening formation, the stratters, a pretty clear one right here in the market. If you grab this, right, and the idea behind a broadening formation is just that. It's just to show the liquidity grabs one way or another. It's basically just the same thing, saying you're in a range, but that range is generally ever expanding until a new trend is developing. The reason it's ever expanding is because you undercut support, you turn on your buy signals there where there's a whole bunch of stop losses getting triggered, then you have that undercut and rally that's kind of happening over and over again. So that's what we're seeing on the SPY, and that's what we're seeing pretty much everywhere on the market. If you look at the Qs, a little bit more beaten down at this low right here, but then bouncing. And then RSP I wanted to look at. So again, RSP is the equal weight S&P 500. It's essentially the same 500 names in the S&P 500, but instead of giving more weight to NVIDIA, Apple, Google, Tesla, all those kind of things, it's just equally spread out. So this tells you what the average large cap stock is doing. And you can see where the SPY undercut that January low and then ripped. We did not do that on the RSP. We haven't even gotten to that January low, and we are above today's high right now. So good outperformance when it comes to the average stock, as opposed to when it comes to these large cap names that can be struggling just a little bit there. So some sectors to keep an eye on here. We have XLI, so always anchoring to this January low, just using that as our anchor point to say if we're above that, we're relatively strong. If we're below that, we're relatively weak. And XLI, which is industrials, John Deere, Caterpillar, names like that, relatively strong there. For that, XLY, which is consumer discretionary, a lot of Tesla, things like this in it, came all the way down to the support. You can see this chart looks actually quite a bit like Tesla for that reason. But XLY, I think, is mostly Tesla and Amazon. Back down to the support zone, putting in a big bottoming tail here. So definitely something to watch. UNG, full disclosure, I am in a bunch of UNG. I'll always kind of say that. I've been buying since around 16, 17, breaking out now, and a nice little gap down and a rip today. So that's an interesting one to keep an eye on. Uh, can't can't have an episode without talking about China. And again, full disclosure, I'm in a bunch of Chinese names. We're just still consolidating at this prior high. This was the high after the Bank of Japan or the Bank of China, I think it's probably called, just threw everything at their economy and said, we are going to give people money. We're going to raise rates or lower rates. We're going to support mortgages. We're going to do everything. Had a big spike, came back down. And when it got over the anchored VWAP from that high, you can see right here, this is where I started to get involved in some Chinese names, right kind of in this area when we spent a couple days finally above it. We're right at that high, so this consolidation makes sense. Any sort of tariff type news, this thing could pop through. Still very beaten up if you look at the overall chart. A lot of room to go to all-time highs, but nice little pop there in FXI. Now, a couple other more specific kind of names. KIE. So, a lot of the trend following names that we got from our system this week were in the insurance sector. And although pulling back with the rest of the market, pulling back less, which is what we want from our trend following names, right? We want less of a pullback than what we are seeing in those names. And that's what we got. So, AL, MetLife, PGC. There's a whole bunch of different names that came through, and sometimes you can see themes. So every time that there was a trend following, there was a name from the trend following system that was in the insurance play. When I saw this ETF, it made me take notice. So that's something that you can do and you can look at as well if you're interested in building your own systems or using the systems over at StatsEdge Trading. When there's a whole bunch that are coming from one sector, you go and you look at the sector itself. So I got some of those names just because this sector looks good and those came from an algorithm. So I have an exit plan. All of that again is built into the system itself. But I just like the way that we held this breakout area right here. And now it looks like we're pushing higher. I know right away where I'm wrong, which is what I always want to do. And then if I'm right, then we get this nice kind of push higher. And then if we get a push at highs, that's going to be great. Again, it's insurance. It's not gonna double, right? It's a good place to have some money while you're kind of waiting for craziness to die down and playing some short-term bounces, which I'll talk about a little bit. And then Hack was the last ETF I wanted to look at. This one's very interesting when it comes to names like CrowdStrike and it comes to all of these different areas where we have a low here and then we have a low back here, all the way down to that low, and we're holding in. So good support around $73, $74 a share. If we can get that support and then we can start to push higher, just a good little entry point. I'm going to look at this, CrowdStrike and all of these, or you can just trade the ETF itself. Again, I'm just looking for low risk places in case the overall market does hold this support zone. You have these low risk places to play off of. But I want to give an example of a trade that came through today that I ended up taking that I'll be out on Monday. Generally speaking, our trades are not this short at Stats Edge, but this is the kind of trade that I really end up liking to trade, where you have the idea behind this system is you look for something that had a big move last week, and that's a big move that happened last week, and then a pullback this week. You have your price. If it gets that price, again, I give you all the prices on the weekends, and then also the Discord alert bot will alert you in real time. Undercut that a little bit, so I'm not just going to trade it because it hit that price. But when we started to come back through that area on this candle right here, I just picked some up. And again, the idea is potentially out of this on Monday because that's just the exit rules. But that's the kind of trades, and that's the reason I wanted to talk about this. That's the kind of trades that have been working over and over and over again. And we have to be quick on these trades. This is one example, one that came through on this day. I bought some, and then you can see what happened a couple days later. So this one I'll probably be a little bit flat on, but the idea is, and the thing that I'm trying to get to you guys is that while we're in this range, the idea is to take the profits when you get them. When you see the profits, you got to take them. You got to move on. You got to be okay with taking less until we have some sort of sustained move higher, right? I have a lot of cash. I'm taking a lot of these shorter term trades. Staying light on your feet, I definitely think is the move. Trading a little bit less. The other way to deal with markets like this, if you don't want to be this active, is by walking away, right? By doing the complete opposite. Instead of being very active and trading very fast and being very tactical, you do something like our monthly rotation strategy, which picks the top 5 names in every market. You know, if the market's going to pull back 20%, this one's probably going to pull back hopefully a little less than 20%. But you just avoid those longer term trends where you avoid the longer term fluctuations. You pick a basket of quality stocks that you like, either from the trend following system, which is really slow, right? The average winner is, I think, 20 weeks, right? The average loser is 4 to 8 weeks. And you just take them a little bit smaller and you just walk away. And then these day to day fluctuations don't really mean as much. So I know it's kind of saying two different things, but those are the only two ways I know to really trade volatile markets. Is you're very tactical, you're in, you're out, you're taking your money, you're moving on. Some people they don't like doing that. In those cases, grab a couple quality names that are in uptrends, walk away, right? Check on it maybe once a week, shut out all the noise, right? Trade a little bit smaller than normal, and you're just kind of muting that volatility of returns again until things get better, until we get up to highs in the market, and then you can start to pay a little bit more attention when it comes to trend following. Right now, it's just this is the reason we trade multiple strategies, because right now we have some systems that are doing better than others, and there'll be periods of time where those systems that aren't performing fantastically right now will perform better, and then the ones that are performing well now will perform worse. So this is why I generally do multiple systems. But if it's not something that you're interested in, then again, either zoom way in or zoom way out. And until I talk to you guys next time, get away from the screens.